you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
Today we have Danielle DiMartino Booth, Chief Strategist and founding CEO of QI Research. If you guys want more information on her company, you guys can go to quillintelligence.com. They have some great research on the market. If you want additional perspective, you guys can get more of that at her YouTube channel, Danielle DiMartino Booth. And in addition to that, you guys, I subscribe to her Substack. I get the Daily Feather every single day. I actually got it today, Danielle. I really appreciated it. I don't know if I love the data accumulation creativity or the title creativity. I mean, white teeth, bad breath. What happens when you have yellow teeth, bad breath?
I got the whole background from Listerine that, who knew that it was originally marketed to treat gonorrhea. I'm like, wow.
Oh my God, I never knew that. Unbelievable. And then in addition, you guys, to that, her resume, she is the author of Fed Up, an insider take on why the Federal Reserve is bad for America. And let's not forget, she also has 9 years of experience as an advisor for the Federal Reserve President of Dallas during the GFC, with an emphasis on the effects of unconventional monetary policy. And Danielle, I am honored to be with you today. I am grateful for your insights. I have the legend. Danielle, how are you today?
I'm doing great. That was, you hit that one out of the ballpark. That was like the best introduction ever. Thank you.
I try. I can't do a lot, Danielle, so I try. And again, I really, really, appreciate your time. I'll get right into it. Obviously I'm in real estate a lot. My industry, there's a narrative that's constantly thrown around. People play with the narrative like, what a crash, what's a crash? So I was hoping to kind of break the narrative. I always like to ask my guests, what their definition is. So the first question I have for you, Danielle, is what is your definition of a housing market crash?
I think when you use the word crash, and you have to use it sparingly, because remember, like the stock market meltdown on October the 19th, 1987, when the market was down 23.4% in one day, that's a crash. We freak out if the market's down 1%, and we're like, oh my God, the stock market's falling out of bed. But it really is on a percentage basis and appreciably lower than where we started. So let's take, I was just in Austin just a few days ago. So Austin went trough to peak. Home prices rose 38%. So they're down 20%. If home prices drop another 25, 30, 40%, I would say that constitutes a crash, because you're giving back all of your gains and then some. And for people who bought at the peak to be down that much, to be that upside down in their homes, that's going to hurt. And I think that in order for anything of that magnitude to happen, that it obviously would not be a location situation. It would be a similar situation to what we had in 2009 and 2010, when it was a nationwide phenomenon.
Right.
So I think you have to have magnitude and latitude.
Okay. I love it. And a lot of people categorize it, Danielle, as like right now we have the transaction crash. I kind of sum it up and corner that word with just looking at prices. But the reality of what you're saying is, things went up so much this time, they're probably going to have to go down even more than the GFC, which was an average looking at quarter, 19%. That's it during the GFC. So, I really appreciate
time. People continue to say, and this is one of my peccadillos, people continue to say that this is nothing like the run up to the great financial crisis. And that is it's a mantra. And my answer to them is, then why did prices go up more? Because they did.
They did, yeah.
And
in half the time.
Exactly. In a very short span of time. And in addition to that, you have to disabuse the notion that leverage was not used this time. These were not all cash transactions. Before we started recording, we were talking about Melody. Melody's teaching Melody Wright. Melody Wright is teaching me a lot about how leverage in the current run-up in real estate was hidden. But that didn't mean it wasn't there. And you didn't ask me the question, but I'll answer it anyways. In order to fuel a bubble, you have to have leverage. And that's why people say this isn't a housing bubble, because they were all cash transactions. We're finding out that that was not true as we figure out where the leverage lies.
Okay, absolutely fantastic. And, essentially to have a crash in price at that magnitude, some type of systemic failure would have to happen. And I want to get into that. I want to ask you about the Fed put. I'm like a little child right now, Danielle. I'm so nervous and excited to talk to you. But getting into the second question, I'm just trying to be honest. I'm so sorry. You probably never want to talk to me again. But the second question for you is, and this is blunt, this is broad, so fly with this, but is Jerome Powell doing a good job?
He's doing as good of a job as he can do. We have to, if you want to go all the way back, in October of 2012, he is on record, you can go back and read the transcripts, as saying this QE business is not a good idea. And we're not going to be able to get out of it one day when we try. And so he's living that nightmare. But yet, in October 2012, he still voted for QE3. So, to me, that makes him part of the problem that he's trying to fix. So people say that I'm a shill for Powell. My reply to them is I have 4 children. And if somebody doesn't stop the madness, given the other people on the Federal Reserve Board, and the fact that they have 14-year terms and they advocate for central bank digital currency and universal basic income and modern monetary theory and reparations and the Federal Reserve resolving climate change. He's not that. So I should be really clear in saying there are a lot worse central bankers than Jay Powell. So at least he doesn't advocate for the worst of the worst of the worst. But he was part of the problem in the sense that he voted for things he shouldn't have.
Okay, yeah. And I'll be honest with you, Danielle, until I started listening to you, I had lost faith in Jerome Powell. I was in an extremely dark place. You actually gave me hope when I needed it during, March of 2023 when they started the Bank Term Funding Program. That crushed my soul because I went through the GFC and they promised us no more bail-ins, no more bailouts. I'm sorry. And I want to get to that. I know you don't call it a bailout, but, what do you think Jerome Powell is hoping to achieve right now exactly?
Well, so we're in February of 2024. By the time we get to May, so March, April, May, so just in just 3 months, he will have stood his ground for 2 years. So we have to step back and applaud somebody who is and has for almost 2 years now orchestrated a controlled demolition of corporate America, the zombie portion of it. So one at a time, bad operators have been taken out. That is an accomplishment. And that to me is right now, when people say, what is he doing? Or the bailout. You can't, what people don't want to comprehend about Silicon Valley Bank. And I do not think, I think that it was a bad signal to bail out, especially all the massively wealthy people who had their uninsured deposits with Silicon Valley Bank. But what I say is this is a marathon, not a sprint. Had he allowed systemic risk to come unglued in March of 2023, a year ago, so no bank term funding program, which was punitive, by the way, but no triage, no triage, we're just going to let the patient bleed out, then he would have forsaken a year of his continued controlled demolition. We would have, he would have given up the opportunity to continue to undo the sins of his predecessors by taking zombie companies down one at a time. Every single time the stock market goes up, Jay Powell has a little bit more runway to take down one more zombie. And if this is the only way to do it without causing something cataclysmic, because everybody's like, let the world burn to the ground. Well, if you do that, then he's duty bound. He's duty bound. Christine Lagarde is duty bound. All the central bankers of the world are duty bound if systemic risk comes unglued and the world falls apart. They have to come to the rescue of the financial system. You cannot just say, let it all burn to the ground, because you'll take down entire countries. People will suffer unduly. Right, so you either have that, because that's how bad the situation is, how difficult it is to extricate themselves from this gigantic failed experiment that he pointed was going to be a failed experiment in 2012. And you know what? 12 years later, it is a failed experiment, but either you double down and end up doing more QE and massive amounts of it to try and use the paddles to continue with the patient metaphor, or you do what he's done. And it's the guy who was in that amazing movie, Heartbreak Ridge, just one more. I've seen it like 8 times. It's a great movie. But all he's doing is, instead of saving one person at a time by lowering them over that ridge, he's letting one zombie company die at a time.
Okay. I love it. I'm blown away by your intel, your expertise. I want to let you know that as we make our way into the next part, which is, I love your term boiling frog. Okay. You like systemic destruction, liquidation destruction, boiling the frog alive. Obviously we need him to stop. We need the Fed to stop purchasing mortgage-backed securities. My God, I didn't realize this, technically 2012, hopefully he undoes that. But that brings me to our third question, Danielle. And I got to be careful phrasing this. I'm gonna try to phrase it down. But originally the question was, do you think Jerome Powell lied? But let me change that. Do you think Jerome Powell smelt the turmoil in the air when he testified, or when he was with Congress a few weeks before the bank runs of 2023? Do you think he knew what was coming?
Oh, I think the problem is that they didn't know what was coming.
Okay.
That's a lot more damning than having known what was coming. A lot more. And he was asked pointedly on 60 Minutes recently about the situation in San Francisco. He was tacitly asked about Mary Daly. And, he basically said that was a failure. And it was a failure. People always mentally silo what they think the Fed is. They're like, the Fed's like the bailout sugar daddy. And I'm like, you have to remember that they conduct more than monetary policy. Their role as a supervisor and as a regulator is critical. It's just as critical as interest rate policy. They must monitor banks. Mary Daly had the CEO of Silicon Valley Bank on the San Francisco Federal Reserve Board of Directors. And because he was inclusive and green, and he hit all of her happy buttons for whatever it is, whatever tree it was she was hugging, she didn't pay attention to the 49 violations that had already been brought to her attention about the actual operations of the bank. So that is a failure to supervise. It's what it was. And it is why it unleashed what was kind of a domino effect. And you realize that you have fallen down as a regulator, because banks fail all the time. You can have a bad apple and fine, let it go. Rotten to the core, goodbye. But if you have a domino effect That means that there's been a failure to supervise.
Interesting.
And taken you by surprise. And shame on you for being taken by surprise, because it's your duty to understand before it happens. And that's why that's his entire modus operandi right now, is trying to change banking regulations so that you uncover the risk in the system that is in the hands of the shadow bankers that have the too big to fail control by proxy of the fact that they're these massive banks' biggest clients. He's trying to fix that, because I can tell you, he doesn't want to work for Joe Biden, and he doesn't want to work for Donald Trump. And he's worth $150 million, and he doesn't need the Federal Reserve's pension or retirement plan or health care. He doesn't need to be there. He can be off playing golf. So why is he there if it's not to try and do what none of his predecessors have been able to do? And that is get a hold of the risk in the shadow banking system.
Okay. That is very, very powerful response. You blew me away with that. It is worse that he didn't know. That's a worse thing. I would prefer he was like Ben Bernanke and just lying until he couldn't lie anymore. But that brings me to the next thing. And I learned this from you. So I give you, specifically you, I give you all the credit. If you can, Danielle, please, would you explain to the viewers exactly what the Fed put is?
So on October the 19th, 1987, Alan Greenspan was on an airplane from Washington, D.C. to Dallas, Texas. He was to deliver the keynote address at an economics conference on the 20th. And when he landed on the 19th, he was rushed by a staffer at the Dallas Fed. Sir, while you were in the air, the stock market crashed. This is prior to the days of Wi-Fi in the sky, obviously. So he gets right back on the airplane, turns around, goes back to Washington, D.C., and says the following day he released a statement saying the Federal Reserve is going to make sure that no harm comes to the banking and financial system. In the days and the weeks that followed, Alan Greenspan leaked through the New York Federal Reserve, leaked to bond traders in advance of Federal Reserve injections of liquidity into the system. He told them in advance. And that means I can front run the Fed. I can profit from the Fed because they're going to help me make money. And that was the birth of what we call the Fed put. And every single time, whether it was long-term capital management that in 1998, or it was the massive quantitative easing, what was launched after the financial crisis hit, every time they had to backstop investors' speculation and make sure they didn't lose money, the Fed put got to be a bigger and bigger and bigger and bigger and bigger monster, to where now I have yahoos on my feed, on my Twitter feed, who insist that the Fed is going to bail out commercial real estate. Insist. And this is something they do every single day. Why do I bring up the fact that it's almost 2 years since Powell said goodbye transitory, goodbye Fed put? And by the way, watch me. It's been almost 2 years. There have been extraordinary losses in commercial real estate. So my answer is, if he's going to bail out commercial real estate, what's he waiting for?
Right.
What exactly is he waiting for? Because it's been almost 2 years. And there's been a lot of bloodletting. And Barry Sternlicht would tell you that the Fed sure as hell has not bailed out commercial real estate.
I enjoyed that answer. That was a fantastic answer. Couple other things. So obviously we want Jerome Powell to break the Fed put, which is basically like the Fed to the rescue when something cracks, like just keep the risk on. The Fed will just bail you out, which seems to be the only bullish narrative left. The bulls aren't even talking about fundamentals anymore. They're just like, they're going to bail us out. There's nothing left.
Without the Fed put, we wouldn't have passive investing. It wouldn't exist because blind investing wouldn't have become such a thing. But you don't have to worry about what you're going to buy. You just close your eyes and buy the latest AI stock. Even though it looks like a hockey stick, it doesn't matter. the Fed's going to have your back.
Unbelievable. Well, not our back per se, the consumer, but So going back to what you said, and this is my fifth question, Danielle, you're knocking it out of the park. You kind of hinted at it a little bit earlier. You said it wasn't a good look, kind of the bailout of 2023. Could you talk about what role the BTFP, the Bank Term Funding Program, had, and maybe a little bit of the reverse repo market and that liquidity, and how that's kind of, I don't know how to phrase it, but causing the lag effects of quantitative tightening for things to take longer. Can you touch on that a little bit?
So two separate things here. So if you're having a run on your deposits, if all of your bank's customers are pulling their money out, and it looks like you're gonna fold, then you have to, Joe Q, Jane Q, CEO has to go hat in hand to their board of directors and say, I'm going to have to go put money up to the Bank Term Funding Program. And I'm going to get 100 cents on the dollar for my security that's worth 80 cents on the dollar. And you probably want my resignation because in order to get this, we're going to have much stricter regulations. We're going to have to raise capital. At which point the board of directors says, you're right. You probably will be giving us your letter of resignation, because that is toxic waste to a bank to have to raise capital or to deal with higher capital requirements, because banks are not in business to not lend, which is what higher capital requirements trigger. They're in business to lend, but it's only something you do if it's your last effort. And what the Fed did in creating this program that got all the way up to $160 billion, it had a capacity of $2 trillion when it was originally rolled out. So had all the banks ponied up and it was really a bailout, it would have been $2 trillion overnight, but that would have been a lot of fired bank CEOs. So they knew better than to borrow because of the penalty that they would have to pay. But it did backstop the weakest players. And on March the 11th, of 2024, we could start
2023.
2024. We're going to start when it closes.
Oh, when it closes. Okay, you're well ahead of me. Of course, I'm sorry.
I mean, Michael Barr's he's no idiot. He's a Federal Reserve governor. He's the vice chair of supervision and regulation. At some point, somebody woke up one morning and said, "Whoa, interest rates have started to fall. I can go play in this facility and get 100 basis points, 1 percentage point on my money. So I'm going to go play." And Michael Barr was like, no, you're not. Sorry, that game's over. So that only lasted a little while. But the reason it stayed so small was because there was a penalty. Now, while the Federal Reserve was raising interest rates, if I am a money market fund, I'm not going to tie my money up in a 90-day treasury if I know that every 6 to 8 weeks the Fed's going to raise interest rates. I'm just going to park my money in this treasury, this kind of treasury surrogate. The Federal Reserve created a U.S. Treasury, a sovereign bond, sovereign bill surrogate with this facility. And as long as you're a money market fund and you want to maximize what you make on an overnight basis, you're going to put your money wherever it gets the highest yield. It's pretty simple. And so it drew a lot of money in when the Federal Reserve was in the process of raising interest rates. Now, when money market funds just said in June, okay, it looks like the peanut butter's hitting the fan. And it looks like the Fed's probably finished raising interest rates. So now I'm going to do what else I need to do to get the best yield. I'm going to buy treasury bills, which Janet Yellen, bless her heart, was all too eager to sell lots more of than what we normally do as a country. So yes, Janet, we know what you're doing. But in that process, the reserve repo facility emptied out because the money market funds took that money and moved it they took it out of the surrogate and moved it into the real thing. into treasury bills. Well, I liken the reverse repo facility to a shock absorber. Mm-hmm. So when it was $2.5 trillion, there was a lot of cushion.
All right.
The economy could hit a deep pothole. The closer it gets to zero, the more of a risk that you're going to break your axle if you hit a really big pothole. And what we will start to see once that facility is fully depleted is reserves start to come out of the banking system. Now, the last time this happened, because of quantitative tightening, we found out the hard way, and the Fed had to launch what was called back at the time not repo, because reserves were depleted to too great of an extent. And when the metaphorical car hit the pothole, overnight rates shot up really high. And that is why the Fed will be treading more and more lightly once we go from 550 billion, whatever the balance is right now, to zero. Because then they'll start to deplete reserves out of the banking system. And that's why they're talking about lowering the pace at which they allow treasuries to run off later this year. The bonus is the Federal Reserve would never take a loss, so they would never sell mortgage-backed securities. For all the morons on my Twitter feed who are like, sell the things. I'm like, yeah, you really want to book a loss when you don't ever have to book a loss because you're the central bank. So by law, you do not have to book a loss. But what the Fed can do as it starts to reduce its roll-off of its treasury holdings is in a whole separate other bucket. It can reduce its holdings of mortgage-backed securities and begin to play catch-up with that process, especially if interest rates, if they start to lower the federal funds rate and more people prepay their mortgages and refinance. So they'll be able to roll more mortgage-backed securities off, which they have not been able to do because prepayments came to a screeching halt, because who was going to refinance their mortgage when rates were so high and they had a 2.75% 30-year fix? Nobody. But as they've come off, we've actually seen in the month of February, purchase applications on a weekly basis hit a wall, but refinancings continue because people they're cashing out the equity from their house because they need the money. So, and that's something that gives the economy a little bit more fuel to make it to the next day. However you get the cash, it's going to float the economy because we're 68% consumption gross domestic product economy.
Yeah. Yeah. And Danielle, and I have some questions on consumers. But people are trading in a 3% interest rate to get a 7% interest rate to get $100,000. But what I'm trying to explain to people is now you've locked yourself into this debt payment for 30 years. You start your amortization schedule all over again. And it's a horrible idea. If you go and purchasing real estate with an expectation to refinance, you're setting yourself up for failure, especially when we have quantitative tightening. It's not like we don't know that there's quantitative tightening. But I wanted to clarify, I just learned something.
Everybody plans on Jay Powell either folding or getting run over by a train. That's everybody's working assumption. Either Trump's going to take him out, which legally he can't do. Actually like mafia style take him out. Or he's going to get run over by a train, or he's going to fold like a deck of cards. But so far, again, that's why I keep reminding you, it's been almost 2 years.
Yes.
And the deck of cards does not fold it.
You're the reason. You gave me faith. I was like, I can't believe you did it, Jerome. You bailed out the banks. I was just spewing bailout. But it makes a lot more sense what you're saying. And can I reiterate, because I didn't know this, are you saying that in order for the weakest of lenders that are accessing the bank term funding program so they don't go under essentially, so they have the 10 basis point fee, I think. But are you also saying that if they draw from that, they are required, basically have to have new regulations put on them for borrowing?
And that is what Michael Barr has said. He has said, if you want to play, you're going to have to pay. And that's why my best friend on Twitter, Stimpy, likes to make fun of people because he's really smart. But that's why he likes to make fun of people. They're like, it's a bailout. And he's like, yeah, but the CEO didn't enjoy the bailout because the CEO had his ass handed to him and got fired.
Right.
But it's a lot of dots it's a lot of dots to connect, and you have to get deep and down in the financial system. And there are a lot of bad actors on Twitter who they're like, if I say it's a bailout, I'm going to get a lot more followers than if I explain what's actually going on. So it's clickbait.
Right. And you know what I love about, it's just really just hitting me just on this video. I'm getting educated as we're going along here. But I mean, you're right. Because originally I was watching the Federal Reserve balance sheet and we saw that 400 billion go up on their balance sheet. And I was like, boom, that 400 billion is for the bank bailout. But when we look at it, there was only 160 billion, still a lot. But like you said, the capacity was 2 trillion. So the fact that they're not pulling from the BTFP means that it's not 100% bailout. It's still, like you said, though, for the normal commoner, it's a bad look because the people at Silicon Valley were the rich people. I think Oprah was there, the California state governor. So I'm just sitting back before I was listening to you, Danielle, and I'm like, how the hell are you going to bail them out and we're going to pay for that? But now you're explaining it a lot more.
Banks are paying for it, though, because the FDIC, in order to pay for that, has raised their assessments again. Jamie Dimon's losing his picking mind because it's all based on how big your bank is. So the biggest bank has to pay the biggest. It's like living in a high rise in Manhattan. A few years ago, my cousin's high rise, they repointed the bricks on the outside of the building. So she got some massive assessment on top of the fees that she already pays to the building. So the FDIC was like, well, you're all going to have to pay to repoint the bricks, and you're going to have to pay a one-time assessment, and it's going to hurt. And we actually saw PNC Bank. We saw during the current earnings season, all of these banks announcing with earnings, and we had to take a one-time charge off to satisfy the FDIC's assessment. So that went straight to the bottom line, which means in English, banker CEO get smaller bonus, which is like Armageddon as far as they're concerned. But they get paid based on their profits.
I will correct myself when talking about the bank term funding program. I won't say bailout anymore. And just to clarify, and I want to go into the job market real quick and defaults, but I'm assuming from Stimpy on Twitter, is that from Ren and Stimpy, the cartoon?
That's what his little character looks like.
So you've watched Ren and Stimpy then?
I don't think I think my children have it. Some probably made me sit through a torture session. I mean, in real life, he's hysterical and a great guy. So
good. That's a great attitude, Danielle. Very great attitude. I wish that some of the trolls would have a similar attitude. I appreciate your service.
Oh, my trolls are such lovely people. But you know what? Though, anytime anybody crosses the line, I just hit mute, and they just magically disappear.
You got to balance your mind. You got to be careful what you let in, what you let out. There's so much coming from everywhere. You're doing such an outstanding job.
Love them, but they got to hate, and then they have to be quiet.
They got to hate. They have to. That's the only way they can live life. I don't understand it. But moving on, I really respect your time. A little bit of a status on the job market. My viewers already know that in December, we had 1.5 million full-time jobs gone, which is like recessionary. Like, when the hell have we had 1.5 million in 1 month disappear? So they know that. I also watched a video that you just put out, great video, I think with David, that you were talking about potentially unemployment going up in March. Can you talk about the status of the job market, why you think potentially unemployment can go up in March as well?
I think what we have here is pent up joblessness. Mm-hmm. And if there's been one hallmark of the current downturn, it's been severance. I mean, talking to people in Silicon Valley, 6 months, 9 months, 12 months of severance pay. And people are like, why are initial jobless claims so low? And I'm like, because they're getting like 60% of $300,000, whatever their salary used to be, doing nothing at Google. They're getting like 60% of that for 9 months. And you really think that they're going to go out and get I think it's like $13,500 a year for California jobless benefits? It's a rounding error compared to what they're getting in severance. But at some point, that's going to run out. Google took a $2.1 billion charge in calendar year 2023. That's a lot of severance. But it certainly has bought the economy some time. And it also has a lot of people who are not in the workforce, not visible in the unemployment rate.
Okay.
Because, well, and let me clarify. Let me be really specific. The job, the economy created X number of jobs.
Mm-hmm.
That's from what we call the establishment survey. So if you call the treasurer of Google and ask him or her, is this person employed? And they're getting severance, they're going to say yes. If you call the employee who's sitting on their ass at home collecting severance and ask them if they have a job, they're going to tell you no. So that's why there's this massive disparity between the household survey and the establishment survey. It's because companies are still paying people, so technically they're still an employee, but the people collecting the severance, they know they don't have a job. And that's why literally a record disparity between the two different surveys. And you've seen 700 some odd people drop out of the labor force just in the last 2 months.
I didn't even have that question, but I always wondered it, and you just nailed it. Especially the severance is the reason for the gap. Let me ask you, talking about the labor market, if I can. Sure. You say so many great things. I got to pick and choose my battles. I wish we had like 2 days to talk, but I know you probably you rest after this, but we got 3.7. Okay. The labor market's getting softened. I went through the GFC myself. I couldn't even, I have all this experience as a prodigy back in the day as a loan officer. I couldn't even get a job at Walmart when the GFC hit. Right now we have 3.7% unemployment, super low. And I like to tell people, Danielle, part of the reason the labor market has maintained through 2 years roughly of quantitative tightening is the lag effects. Part of the reason for those lag effects was the sheer amount of money, and we cannot comprehend this as consumers, of the PPP. And I'm not talking about prepayment penalty. I went through the GFC too. You know what a prepayment penalty, PPP. Yeah. But also the payroll protection program for the viewers. They get upset if I don't break this down. And then the EIDL, which is economic injury disaster loan, 3.2%, simple interest, 30-year loans. I mean, my God, you've never had that before. So we got all this money being pumped in to keep these businesses open through lockdown. So do you think that's a big reason why the labor market has been only softening a bit? But again, I know when we peel the onion layers back, we see full-time employment, we see these things. But again, when I compare GFC, I mean, I was broke. I couldn't get no job nowhere. And I'm warning these young kids, like these days, like y'all young kids that have never gone through any type of unemployment phenomenon. You guys are used to getting sign-on bonuses. Yep. I'm used to a 10-page resume that smells like lavender, with matted paper, with a cover sheet, like, please, for the love of God, call my references. They'll say glowing thing. And they're getting begged, Danielle. So they don't get it. Can you explain why people need to pay attention to the sheer amount of money that was kicked in from PPP and EIDL?
Well, I mean, the Paycheck Protection Program pumped about $757 billion was completely forgiven. I don't have the figures on the EIDL, but I will find them. That's going to be my new project. The employee retention credit, however, pumped about another $550 billion into the economy. So that's $1.3 trillion. And it went to mostly wealthy, high-end, high-income earners who bought Bentleys and flew first class and went out to lobster dinners and stayed in nice hotels, and you ended up paying, there's somebody put a number on it a few nights ago when I was at a dinner in New York. I think a room service waiter in a New York unionized hotel makes north of $100,000. So you paid a lot of people, a lot of money, and now these programs have run out.
Right.
And right now you can't get Congress to agree on much. They sit and fight about everything because it's an election year. So, is the GOP Mike Johnson House of Representatives going to write a big stimulus check to keep Joe Biden in office? Probably not this year at least. So
probably not. Yeah.
Telling people that because those are the other idiots on my my Twitter feed because they're constantly saying, the government just sent us a check. And I'm like, that's all good and well, ... in April 2025. But just buckle up until then. Yeah.
Knocking it out. Obviously, we got labor market softening up. We got the money running out, which we can't even fathom. My God, trillions of dollars it's running out, which brings me to my next thing. Something that, we don't have, I would say, like a phenomenon spiraling out of control yet, but I'm going to bring consumer defaults to consumer delinquencies. When consumers stop paying, everything closes down. Even just a 30-day late payment, a consumer gets one 30-day late payment on a $30 credit card, devastating to their credit. Their purchasing power is shot. So can you talk about the consumer defaults? I just did a live this morning. My viewers understand credit card delinquencies up past pre-pandemic near 2011 levels. Just normal car, 2011 levels as well, not counting subprime, which is more. FHA at almost 10%. Can you talk about the consumer defaults and why that can cause such a burden for the financial markets?
So, coming through the most recent earnings season, lenders are charging off a lot of losses due to defaults. Now, until that process ends, and by the way, it's just begun because the unemployment rate is 3.7%. So until that process ends, banks will continue to tighten lending standards in a debtor nation. That doesn't work. And, people need to understand that everybody's rushing into buy now, pay later because they can't get money from other sources. So this is a problem. And it has become, and it's especially a problem for the 20 to 29-year-old and 30 to 39-year-old, because the New York Fed data that you're referencing, that card delinquencies are the highest since 2011 and credit card delinquencies, that's for all age cohorts. But when you narrow it down to the younger cohorts, they're at the highest level, they're almost back at financial crisis highs for the youngest borrowers because they've never known recession. They don't understand contractual obligations. They're boycotting their student loan payments. They are Googling asinine terms like give car back. So they don't understand the concept of it's actually got a formal name. It's called repossession.
Yeah, exactly. It destroys your credit.
They don't understand. They don't understand. And, a third of Gen Zers, rely on mom and dad. So that's going to continue, the reliance on mom and dad.
I mean, not only do we have all these things with the younger kids, this not real labor market. I mean, I don't want to get political, but don't pay your student loans off. There's like a whole cult following, like, oh, we're not going to pay. Like, what do you guys talk? Like, that's only going to hurt yourself. It's, luckily they have their grace period. It's just, there's so much. They actually think that they're sticking it to the boomer. And I'm like, how? It's the other way. They've never gone through the process. Right. They've never had their credit impaired. And right now, at least, they've got buy now, pay later. Right. We never had that. That's insane.
Well, I mean, when I was, it's called layaway, but
Right.
you wouldn't get what you were buying.
Right.
You paid it off.
Right.
And yet it's incredible what you can use buy now, pay later for. I mean, things that just vanish into thin air. I was getting my hair done yesterday. My hairdresser said that she was approached by a lender to use buy now, pay later for a haircut. I'm like, how do you collect on that? I
mean, geez, my God, like maybe just go get some cans in the parking lot. Just stop your spending habits.
Your credit. So regulators right now are scrambling because if you're a credit card lender and somebody calls and says, hey, would you increase my limit? Okay, they look, they run your credit, they look and see how much credit you've got. They wouldn't know if you had you can get it a self-checkout kiosk at Walmart now, from $400 to $4,000 of buy now, pay later credit at a self-checkout kiosk. No human being allowed. You just pull up the Affirm app. You put in your social security number, your phone number, your address, and you immediately get approved for buy now, pay later up to $4,000. But your credit card company doesn't know that. The GM financing or Toyota financing, they don't know that. So regulators right now are way behind the 8 ball trying to catch up with this thing. If you can imagine global data, they have proprietary credit card analysis. They said that in the month of December that they recorded $55.8 billion of incremental credit card spending, which of course didn't show up in the Fed data. Wells Fargo ran an analysis that shows that buy now, pay later is growing at a third of the pace of credit card borrowing. So that's about 18 billion more in buy now, pay later. And everybody's like, I wonder why retail sales were so strong in December. I'm like, well, because that's when that's the exact month that Walmart rolled out buy now, pay later.
There's so many problems with buy now, pay later and that debt not reporting on someone's credit profile. Obviously, I've been a loan officer for 20 years. In order to calculate someone's affordability, debt to income ratio, DTI, you have to know how much they're paying. And then the fact that they're getting this at a register is not even a collateralized debt. They don't, with bad credit, I mean.
Say in Walmart's defense, it's not for groceries.
It's not.
But you can get, but other vendors, you can get buy now, pay later.
For groceries.
Yeah, I mean, I heard a Gen Zer talking about they were able to pay for their Mai Tai in 4 payments. A drink at a bar.
Yeah, America's got a spending problem, I'd say. I'm trying. I don't know what's worse, Danielle. Is it the patience problem or the spending problem? Probably the spending problem is worse.
Well, but it's one and the same because it's instant gratification. And that's this entire, I mean, I hate to be like the old lady wailing on the young people, but my work ethic and, having to work for my credit, when I mean, all that, it shaped who I am as a person. And it helped me raise my children with this little thing called integrity.
Yes. Yeah, I mean, I drug my way out of the gutter. During the GFC, I got swept up. I was a mortgage loan officer. So when the business shut down, I couldn't pay my mortgage, led to foreclosure. They sold that. I had a deficiency notice, I had a tax lien that exceeded statute of limitations because I was at a bankruptcy and in a volunteer repo. So I had to drag myself through 9 years of hell, living paycheck to paycheck, stressed out. Okay, I got my rent, I got my daycare, I got my chicken for dinner, kind of a full-time father. So, I mean, I hope that these kids are going to be okay. I'm trying to round us out. Couple more questions.
It's 2024. So come Halloween, all these student loan boycotters, all of a sudden, boom, it's going to show up on their credit.
That's bad, man. That is so. Their balance is also going up, is what I'm trying to tell people, because the interest is accumulating.
They don't care. They're sticking it to the old people.
That's not how it works, though, young kids. Not how it works. So rounding us out, Danielle. I know no one's a fortune teller. This is a bit of a naive question. I get it, but what do you see one of the kind of the biggest it's naive, I know, but one of the biggest black swans is that we're coming into lag effects, maybe QT, geopolitical, commercial real estate. What do you think is the greatest? What's the greatest risk post the economy right now?
The election.
Oh, good answer. Why?
I don't think either side's going to believe that either side wins if either side wins. There are a lot of angry people in this country, and it really bothers me. And by the same token, the silent majority is enormous. They don't have anybody to vote for. So even the silent majority is angry. Everybody's angry, but for different reasons.
I mean, you suck the words. And my job is to talk, Danielle, not as good as you, but you just suck the words out of my soul with that one. Did not see that coming. Election. I mean, brilliant, absolutely brilliant. Last question. Maybe naive as well, but do you think we will, Real Estate Mindset's the name of my channel, my industry is real estate, blah, blah, blah. Will we, in your infinite wisdom, and you have a lot, will the housing market crash?
I think that we're going to have a severe downturn in residential real estate. I don't know that it's going to crash the way I defined crash, but I think we're going to have a severe downturn. A monkey could tell you that the stock market was really overvalued, is really overvalued. NVIDIA is acting like Priceline.com did in 2001 when an analyst put $1,000 price target on the stock. When things start to melt up at a violent rate, that's when you know that they eventually will come down. And 10 years ago, 12 years ago, 15 years ago, baby boomers were a lot younger. I had to do my math right, 2009. 15 years ago, baby boomers were a lot younger. This time around, the equity that they've got built up in their homes, when the stock market falls, and again, I think a monkey can tell you that the stock market's overvalued right now, but when the stock market falls, if you're 75 years old and you were 60 back then, 60 was easy. I'm going to stay in the workforce, or I'm going to go be, I'm going to go work at Home Depot, and I'm going to jump back in the workforce for 15 more years. If you're 75 years old, you're not saying that. So because we've had so much leverage come in with the Airbnb jocks, because I believe that recession started in October of 2023, recession will take the stock market down, and the stock market will take down baby boomers. So you're either going to have a lot of an increased growth of multi-generational households, which we're seeing. A lot of. But either you're going to have an increase in multi-generational households in order for two generations to be under the same roof and afford to cover the mortgage, or the baby boomer is going to cash out on that equity that they've built up in their home in order to fund their retirement.
Okay, great answer. And now can you see?
So on top of them.
Can you see, Danielle? Obviously, you had a very specific definition of a housing market crash. I love it so much that you would explain that, and I understood exactly what you're saying. Can you still see? Say that again.
Magnitude and latitude.
Magnitude and latitude. I will educate myself more on that. Can you see? Not necessarily that we have to have some type of systemic failure, but just an affordability and equity run up alone. Can you see a 20% decline in just prices, absent some type of economic, turmoil that's long lasting? I mean, can you see a 20% decline without a crash per se?
Sure. That's called a correction.
How would you define a housing market correction?
20%.
20%? Okay. Just
like I would have, the stock market.
All right. Awesome. Well, other than that, I got one more question from Discord. All right. I'm sorry. Kick me off if you have to kick me off. It's just I've been waiting so long to talk to you. You're kind of a hero. So I'm trying. Hopefully, I'm keeping my composure. But like on the inside, dude, I texted Melody right before this. I'm like, Melody, oh my God, I'm freaking nervous. And she's like, don't be nervous. You know how sweet she is. She's like, don't be nervous, Travis. You got it.
Did you sure set that up?
Did you finally now just notice this?
Oh,
yes.
Well, the F and the P were covered up.
Oh yeah, for my name. Yeah.
That's hysterical. I love that. That's fabulous.
Thank you. That was obviously in your honor.
Wow, that's awesome. Sorry.
It's the little things. It's okay. It's you found it. It's the little things.
I'm very detailed.
So I don't feel as bad asking this last question. This is straight from our Discord community. Jeff M. He's a longtime viewer. He wanted to know your personal answer to this question. What would be, in these times of toxicity and overvaluation, what would be your favorite short-term investment, like 1 to 2 years? What can you tell consumers as far as a short-term investment?
Well, I think right now, I think anything that holds data. I think anything, because we're creating so much data through artificial intelligence. We are creating massive amounts of data. So that trend is in its infancy. And, quantum computing, the next generation, not AI per se. I'm not saying go out and buy NVIDIA. I would have to be psychotic. But harnessing what the next generation's going to be, that's going to capitalize on these new technologies. That, I think, is someplace that you want to be there at the forefront. And if Jay Powell's remotely successful and manages to stay in office through May of 2026 when his term ends, and if he's remotely successful, cash is going to also pay you for the next few years. Now, if something, if the economy up and dies, then all of a sudden your cash won't pay you squat. But it is boring, but it sure does beat buying high yield bonds with spreads at record lows.
Yeah, and something tells me you don't like to be boring, Danielle. You said in the beginning of this you're a bit of an adrenaline junkie. So yeah. I don't think you're a T-bill and chill. I was waiting for the T-bill and chill. I'm like, this is so naive a question. Why would I ask this? But you slammed it, you dunked it, you did all of that. And listen, before we go, do you have anything to, you've said so much gold. I really hope people just get 5% on what you were saying. Anything you want to say before we close this out?
Vote.
I love that. When are you going to be president? When you're running, I'll vote.
I thought about
it. You need me boots on the ground. I'm your boy, boots on the ground. Me and Melody are killing it out there. Hit me out. I'll be a boots on the ground. I'll be all over wherever you need me.
You can be my manager. Yep.
You thought about running for?
I thought about it.
Well, you should. You got one voter right here. I know we need maybe a few million.
I'm asked with great regularity. I do have to bear in mind, though, I do have those. Just like you, I've got 4 children. Mine are not quite as.
It's scary, Danielle. I'm scared. When I went to New York with Melody and she gave me a tour around the city and I felt about this big. I felt so small in that city. And I was like, man, look at these families and look at all these wealthy people that just got their hooks in. We got to stand up even stronger. We got to be even louder because look at what we are against. So I love what you're doing. I love your perspective. You guys show Danielle some love. Everything I mentioned is going to be linked in my description. Her book, everything's going to be there. You guys will be able to follow her easily. And other than that, guys, I'm going to let her go. We're rounding the hump now. If you're out there investing in real estate, you guys already know I wish you luck, and I hope you win.